This is a snapshot of the latest equity funds categorization as laid down by SEBI. So let's quickly go through this picture to understand the different categories of equity mutual funds. As already discussed, the first 100 companies on the basis of full market capitalization are large cap companies. The next 150 companies are mid cap companies, and the 250th company onwards are the small cap companies. So, a large cap fund is a mutual fund where at least 80% of the portfolio is invested in large cap companies. A mid cap mutual fund is one where at least 65% of the portfolio is invested in mid cap companies. And a small cap mutual fund is one where at least 65% of the portfolio is invested in small cap companies. A multi-cap fund is one where at least 65% of the portfolio is invested in equity, and it can be invested across the universe of large cap, mid cap and small cap stocks. A large and mid cap fund is a combination of large and mid cap stocks. Here, at least 35% of the portfolio is invested in large cap stocks and at least 35% is invested in mid cap stocks. A focused fund invests in a limited number of stocks as well as sectors. It can have a maximum of 30 stocks. In a sectoral or thematic fund, a minimum of 80% of the portfolio is invested in a particular sector or in a theme as per the investment objective of the fund. In an ELSS fund, a minimum of 80% of the investment is in equity. The next type under equity mutual funds is a multi-cap mutual fund. The cliched investment doctrine that don't put all your eggs in one basket is best followed by a multi-cap mutual fund. A multi-cap mutual fund is the most popular category of equity mutual funds. The fundamental concept based on which a multi-cap mutual fund works is diversification. And why is this concept so popular? Let's understand this with the example of our Indian cricket team. We have some excellent batsmen like Virat Kohli and Rohit Sharma. We have Bhuvneshwar Kumar and Bumrah bowling the spunk out of the best batsmen in the world. We have Rahane and Pandya protecting the borders. And we have the world's greatest wicketkeeper, MS Dhoni. If we hadn't had the best of any one domain, we wouldn't have been standing where we are today. Similar is the strategy of a multi-cap mutual fund. There's absolutely no restriction on sectors or on themes or even market caps. A multi-cap mutual fund can invest in any sector or theme or any big or small stock wherever the fund manager sees an opportunity. Since there is no restriction, the fund manager picks the best stocks from across a large number of sectors and capitalizations. And in a multi-cap mutual fund, the portfolio generally comprises a large number of stocks. Hence, a multi-cap mutual fund invests in a mix of large cap, mid cap and small cap stocks. And secondly, a multi-cap mutual fund diversifies across a large number of sectors. Hence, there is no one sector dominating the portfolio and therefore no one sector can significantly impact the overall portfolio performance. About the diversification approach of a multi-cap fund. Diversification significantly alleviates the portfolio risk. The risk here is comparatively lower than a sector or a thematic or a mid or small cap fund. And secondly, the fund manager can pick any sector which shows bright future prospects. To conclude, we have some examples for multi-cap mutual fund, Kotak Standard Multi-Cap Fund, SBI Magnum Multi-Cap Fund and Invesco India Multi-Cap Fund. The next category of equity mutual funds is index funds. The portfolio of an index fund replicates an index such as the Sensex or Nifty or BankX, etc. Fund manager of the index fund will invest in the same stocks as that of this index and in similar proportion. Therefore, in the index, whenever there is a change in the allocation or there is a replacement of a stock, the index fund will also incorporate this change in its portfolio. An example of index fund is Reliance Index Fund Sensex plan. So this scheme will be replicating the Sensex. The index fund manager does not have to brainstorm for stock selection. He or she has to blindly follow the index. Hence, an index fund is a passively managed fund. Hence, the expense ratio of an index fund is also way lower than other actively managed funds. Currently, the maximum expense ratio allowed to an index fund is 1.5% of the average daily net assets of the scheme, irrespective of the portfolio AUM. So the main question that arises here often is, why should the investor invest in an actively managed fund like a diversified fund and not an index fund, since both invest in equity and the expense ratio of the index fund is lower? The answer to this lies in the fact that an actively managed fund does not follow an index. It has the liberty to pick stocks from out of the index's horizon. The fund manager selects the best stocks within the investment objective of the scheme. So if you compare the average returns generated by an index fund, let's say a Sensex fund, with a large cap or a diversified fund, the latter would have been able to outperform the Sensex fund by a significant margin. This is a snapshot performance comparison of an index fund, the Reliance Index Fund Sensex plan, the Reliance Growth Fund Growth Option, which is a diversified equity scheme, and the index, that is Sensex. As we can see from the chart, the diversified fund, Reliance Growth Fund, has consistently outperformed the Sensex as well as the index fund, the Reliance Index Fund Sensex plan, by considerable margins. This outperformance justify the efforts put in by the fund manager, and it also justifies the higher expense ratio associated with the diversified equity scheme. Also, as you can see from the chart, the returns from the index fund are almost similar to that of the Sensex over all investment periods, 3 years, 5 years, as well as 7 years. This is because the index fund is a mirror image of the Sensex. So, if an investor wants to invest in the Sensex, he or she can invest in the Sensex via a Sensex index fund. Lastly, in a growing market like India, there is a plethora of opportunities available in the market to outperform the index, that is the Sensex or the Nifty. Unlike a mature market like the US, where markets are so stable that it becomes very difficult for the fund manager to supersede them. Hence, if an investor wants to invest in an equity mutual fund in India, then going for an active fund makes more sense.